Hey everybody, it's Matt. If it looks like I'm really, really excited, it's because I am. We, I'm going to be talking about options today, and this was the first asset class uh, that I traded when I became a trader. So I have a secret spot in my heart for options. But this is the big idea behind the entire presentation. Sometimes a stock doesn't need a major news catalyst to make a major move. So the whole concept of options is really cool. It can move the stock price just by them being available. You'll see. Hold on. So retail options activity can create a mechanical chain reaction through dealer hedging. And once that process gets going, the price action can start feeding on itself. What looks like irrational momentum on the chart can actually have a very specific explanation underneath it. Positioning, delta, gamma, and hedging flows. Retail call buying. So a lot of retail traders buying calls, just long calls, doesn't just move the stock, it can move the market makers, the big boys. Picture a stock that's been grinding sideways. Nothing exciting is happening. Then retail traders come in, they suddenly pile into short dated, out of the money calls because they think a breakout is coming. The important part is what happens on the other side of those trades. Who's selling those calls to them? The dealer selling those calls generally isn't trying to make a directional bet on the stock. They try to remain delta neutral. They're collecting option premium while managing the risk created by the position. And that risk management is where the interesting part begins. Let's simplify the first step. You buy a short dated call. The market maker sells it to you and collects the premium, but they have that risk, right? But now the dealer has exposure to the stock through that option. So they hedge that exposure by buying shares of the underlying. The objective is to keep their overall position, as I said, as close to delta neutral as possible. That means the retail call buyer may be creating stock demand without actually buying the stock directly. Isn't that cool? I think it's interesting. The stock purchase is coming from the dealer's hedge, not the retail trader. Now imagine the stock has been sitting there doing almost nothing. Retail starts buying those short dated out of the money calls. The dealer responds by purchasing shares to hedge the calls they've sold. That initial hedge creates some buying pressure, especially if there are no sellers of the actual underlying sitting there. And if that buying pushes the stock even slightly higher, guess what? The next part of the mechanism starts to matter because the option sensitivity to the stock price is changing. The first hedge can become the beginning of a much larger feedback loop. This is where the mechanics get really cool and interesting to me. As the stock moves higher, those calls move closer to the money, meaning the strike price. And consequently, their delta increases. And because the dealer's hedge needs to reflect that larger delta, they buy more additional shares. So you get a sequence. The stock moves higher, delta increases, the dealer needs more shares. That additional buying can push the stock price higher again. And now we're moving from a simple hedge into something that can accelerate. This is the feedback loop. Buying causes more buying. More buying pushes the stock higher. The higher stock price changes the options delta faster, and that forces the dealer to adjust the hedge again. That's the significance of gamma. Gamma measures how quickly delta changes as the underlying stock price moves. So when positioning is large enough and the options are close enough to the money, the hedging response can become increasingly aggressive. That's why a stock can suddenly appear to go vertical without a corresponding explosion in fundamental news or anything. The market isn't necessarily reacting to new information. The positioning itself can become part of the price action. Here's the difference between watching the market and understanding the mechanism. A typical trader is watching price. They're looking for news, breakouts, chart patterns, momentum. Professional desks are also watching something underneath the price. Dealer positioning. They're trying to understand where the options market may create stabilizing flows and where that positioning can flip into an accelerating feedback loop. The key question isn't simply, is the stock breaking out? It's what happens to dealer hedging if the stock moves through this level? That is a much more useful way to think about a potential squeeze. Remember what happened to GameStop? That's what I mean when I say squeeze. That hypersonic move that didn't make sense. That was a squeeze. But no feedback loop lasts forever. Professional desks are also looking for the point where the fuel starts to disappear. That can happen as the relevant open interest, so how many option contracts are still open, gets exhausted. Positions are closed or expiration approaches. And once the underlying option exposure changes, then that need for those stock hedges changes with it. That's the important thing to remember. The same positioning that creates acceleration on the way up can eventually stop supporting the move. A squeeze has a life cycle. And this is the part people often miss. The mechanic works in both directions. If the dealer no longer needs the same amount of stock as a hedge, those positions can be unwound. So they start to sell everything. So the buying pressure that helped push the stock higher can become selling pressure on the way back down. That's why these moves can reverse so violently. The exact same market structure that helped launch the stock into outer space can help slam it back down to earth. The squeeze isn't a one-way phenomenon. You gotta remember that. It's a two-way hedging process. So let's put the entire process together. First, you have the grind. The stock is moving sideways. Then comes the spark. Retail piles into short-dated out-of-the-money calls. And if you stop for long trying to understand the why, you'll miss what matters. It doesn't matter why. Just keep keep going. The market maker hedges those calls by buying the underlying. Then comes the inflection point. As the stock rises, delta increases, and gamma exposure can accelerate the required hedging. Eventually, the position runs out of fuel. Open interest gets exhausted, people start closing their option positions, or expiration arrives, accelerating that even more. And finally comes the unwind. The dealer no longer needs the underlying to hedge, so the hedging flow reverses. That's the entire life cycle. And the takeaway is simple. Mechanics can dictate price in equities, not just the other way around. And that's what's interesting because of the options market. When you understand the positioning underneath the chart, some of the market's most violent moves start to make a lot more sense. All right, guys, reach out with any questions. I love talking about options. Sorry. Trade well, my friends.